Hello everyone, and welcome to this General Index Eurobob Non Oxy Derivatives launch webinar. My name is Andrew Wheeler, Marketing Manager for General Index, and I'll be your moderator for today. Your General Index speakers for this webinar are Neil Bradford, CEO and founder of General Index, Sake Venprala, Managing Director for Europe and Africa Markets, and Jonathan Hill, Head of Compliance at General Index. I'll shortly hand you over to Neil, but before I do, some housekeeping items. First, this webinar is being recorded and will be made available to you after the event. And second, we'll be holding a question and answer session after the webinar. However, please feel free to ask any questions during the webinar by using the Q&A function at the bottom of your screens. Now, without further ado, I'll hand you over to Neil.
Thanks, Andy. Just 1 second. Thanks, Andy, and good morning, everyone. We're delighted you could join us this morning, as it's quite an exciting development for, we hope, General Index and also the gasoline market. As Andy mentioned, we'll give you an overview of GX and then talk a little bit through where we see gasoline with my colleague Saket, talk through the listings that are coming up next week, and then also how we view compliance and custodian of the GX benchmark. So yes, as we said, we're delighted to be here, and if you do have any questions, please put them in the chat. We'll answer them as we go. Okay, so let me just start off with a little introduction to General Index, and I think many of you know us over the course of the past few years. So Andy, next slide, please. As many of you will know, we launched General Index as what we believe is the world's first tech-native benchmark provider. We basically believed 3 years ago there was another way to do this, to provide the industry with critical pricing information. And we did that partly because we wanted to use technology, and partly because we believed there was a best way to deliver this at a lower cost for the industry. So we've been going now around 3 years. And we see ourselves, first of all, as an alternative to those high-cost incumbents for existing markets. We're also increasingly launching new prices for new markets, such as hydrogen, carbon, sustainable aviation fuel along the way. We're based here in London. We're a team now 40 around the world. We have a team in Houston. We have a team in Singapore. We have a team in Krakow in Poland as well. And those teams put together the data and the methodologies for the price benchmarks, which are then produced by our technology system we call TRIP, and fully coded in Python and produced every evening. So we're a pure play benchmark provider. We're not producing reports or news or running conferences. We're purely here as your benchmark partner for the energy sector. Over the past 3 years, how have we built out? Well, we've built out, first of all, we're authorized here in the UK as a benchmark administrator, and we follow across all of our benchmarks the IOSCO principles, which is approved and signed off in an annual external IOSCO audit. And we've built up a fantastic amount of trade data that we're gathering. We're gathering from APIs and from systems over hundreds of prices per day from over 130 companies around the world. And that's enabled us to be producing daily over 2,000 prices in crude, products, and LPG. And what we've seen is companies have adopted us, including national oil companies, international oil companies, traders, energy firms, consultancies, and banks. Firms have adopted us initially for their analysis purposes, initially for a lot of internal use, mark-to-market, transfer pricing, those kinds of things. But of course, what we're here to talk about today is the increasing interest in use of GX in trading, and especially when there's a new change to a specification and a new price is required. Finally, we're available, our data is very easily available via our API or via a whole range of partnerships we have. Bloomberg, we recently, just this week, announced a new partnership with Refinitiv as well. And just a few weeks ago, we announced one with ICE Connect too. So our data is very, very easily available to you, your trading partners, and to get into systems. So we're excited to be the new the new player in this space, just a few years old, and we're excited today to be talking about the fact that we have a futures contract launching next week based off our numbers. And I'm going to hand over to Saket now, who's going to talk a little bit more about the gasoline market and why it's the right time for E10 and why it's the right time for GX in that space as well. So Saket, over to you.
Thank you very much, Neil, and I'd like to extend my personal welcome to those of you who joined in today's webinar. We're very happy to have you and very happy to give you an update at what we believe is a key milestone in the market adoption of a general index. Before we do, though, I'd like to maybe set things in a little bit of context as to how we arrived at this point in terms of the market utilization of E10 gasoline. Many of you on the call who are active in the market will already know that for many decades, the main price benchmark reference for Northwest European gasoline was the Eurograde EN228 barges in ARA. But then once EU directives for blending of ethanol into gasoline began coming into effect, starting around 2009, we began seeing increased trading activity in blend stocks that were suitable for the addition of ethanol to reach the EN228 specification. These blend stocks already contained a small amount of oxygenates, such as MTBE, and thus was born the Eurobob Oxy market, which became the benchmark around 13 years ago. For a long time, E5 was the standard across much of Europe, but as environmental directives and increased use of biofuels kept pushing to the top of the agenda, more and more countries in Europe began moving towards E10 gasoline as a way of meeting their environmental mandates. So the situation we have now is 16 countries across the European region have adopted E10 gasoline as the standard grade available at the pump, with a further 5 countries now making it available alongside the standard grade. And those countries are highlighted in the map that you can see on the slide. One could argue that the key moments in this transition were the adoption in 2017 and 19 by Belgium and Netherlands of E10 gasoline. And both these countries followed similar paths in that E10 became the standard grade at the pump, and E5 was relegated to the protection grade, or the super or high octane grade, thus ensuring that the bulk of gasoline consumption in these countries moved over from E5 to E10. And the reason why one can consider this a tipping point is because all ARA regional terminals, as of those dates, were now in E10 countries, and of course ARA being the main blending and export hub for gasoline in Northwest Europe. Since then, subsequent to the pandemic, we have seen more and more adoption of E10 across Europe. In September of 2021, the UK moved from E5 to E10 gasoline, followed subsequently by Ireland. So now across the British Isles, you've got just over 20 million gasoline-fueled vehicles that are now largely running on E10 gasoline. Meanwhile, across the Channel, France, which has long been very enthusiastic about the adoption of ethanol, has seen sales of the E10 blend now exceed the 50% threshold. This is, of course, the land of the E85, where that very high ethanol grade has market share of something like 7%. But nonetheless, the E10 itself is now well over half of consumption. The biggest economy, of course, in Europe, as everyone on this call probably already knows, has long been skeptical in the adoption of E10 gasoline. There were some concerns that the higher ethanol would have an effect on the performance of vehicles in this country. But nonetheless, despite that historical reluctance to adopt E10, what we have observed in recent years is a steady increase in the share of E10 out of the total gasoline consumption in Germany, and it has now risen to 25%. And there are indeed parts of Germany, particularly along the Rhine region, where it is believed to be higher than that. Rounding things off, more recently, we had adoption in Austria a few months ago, Norway later this summer, and Poland to fully adopt next year. By some estimates, across Europe, end user gasoline consumption is now about 50% E10, depending on how you measure it, largely concentrated in Northern and Central Europe. And so we can now say that end user consumption has reached a tipping point in the journey from E5 to the higher ethanol E10 blend. Next slide, please. And this shift has been mirrored in the traded volumes that we see in the spot barge market. And so this is data that you see on the screen going back to the start of 2018, measured in 1,000 tons. This is the volumes of barges that are trading on an all-day basis for both the Oxy or E5 as well as the non-Oxy or E10, which is in orange. And if you go back to 2018, you can see very clearly that Oxy volumes dwarfed those of non-Oxy. But then subsequently, over the following year or two, a combination of a change in the methodology in non-Oxy from being assessed as a differential to the more liquid Oxy grade to becoming a standalone volume-weighted average assessment unto itself, as well as the entry into the E10 market of more market participants, helped to boost volumes in the run-up to the pandemic period, as you can see, particularly in Q4 of 2009. And although E10 volumes have increased, they nonetheless appear to have largely flatlined around the 400,000 ton per quarter mark, while the Oxy volumes have fallen off. We can see, therefore, that non-Oxy has effectively reached parity with Oxy in terms of the spot traded volumes, coming up from being a small fraction of the Oxy volumes, indicative of the fact that clearly more people in the market see the non-Oxy barrel as being representative of gasoline fundamentals, not just in Northwest Europe, but also to some of the key export markets to which Europe sends its gasoline cargoes. Next slide, please, Andy. However, as we all know, this shift has not yet been manifested in the paper market. So this is some data that we pulled together from publicly available data from the ICE exchange, showing open interest in some of the key gasoline futures contracts. And as you can see over here, the various shades of blue show you the open interest figures for E5 or Oxy gasoline, spread across not just outright futures, but also cracks to crude and some of the key arbitrage routes. And the thin sliver of orange that you can see at the top of the pie chart represents, as of June 19th, the total open interest in all the non-Oxy instruments that were listed on the exchange. And so the key message that we're trying to get across here, contrasting the two slides, is while the physical volumes in the spot market have moved more assertively towards E10, liquidity on the paper side has been much slower to shift. And ultimately, a lot of the hedging is still happening on the E5 paper. Next slide, please, Andy. And so this then gets to the crux of the issue as we see it. While physical trading is moving from the E5 to the higher ethanol E10 blend, there is still a lag happening on the paper market. E10, as again, everyone on this call probably already knows, is a much more fungible grade. So not only is it increasingly more and more representative of the European and certainly Northwest European markets, but the absence of MTBE means that it's more easily fungible to some of the key export markets and therefore is a more representative grade when you're looking at, for example, the arbitrage to the US. But the wider oil market, and here we're not just talking about physical market participants, but we're also talking about critically the paper market participants, continue to use the legacy E5 Oxy instruments for hedging and for price discovery. And our conversations and engagements with the market have led us to the view that this specification mismatch between what's happening in the physical market and what's happening in the paper market is having the undesirable effect of contributing to thinner market liquidity. Given Europe's importance to the global gasoline market, the net length, and the fact that you've got these historically established key export routes from Europe across the Atlantic, down to West Africa, to other regions, and the backdrop of the changing quality specifications from E5 to E10 necessitates, in our view, and we believe market consensus, two E10 non-Oxy settled derivatives. Further adding impetus to this migration in liquidity from E5 Oxy to E10 non-Oxy is the fact that from next year, there will be a methodological change in the physical assessment. And so the E5 Oxy assessment will no longer be a volume-weighted average of deals unto itself, but will rather be assessed as a differential to the E10 Non Oxy quote in order to help encourage a faster acceleration in the migration from one grade to the other. And the E10 derivatives, which will be receiving all of this liquidity, we believe, that's currently sitting on the E5 paper, in other words, all the blue on the pie chart that you saw just a minute ago, must settle against a benchmark, we believe, and the market, I'm sure, would agree, that's calculated with a consistent and transparent logic. Which brings us to our next section, and that is the role of general index itself. And the next slide, please. Let's move on to the next one, please. Thank you. So, harking back a little bit to Neil's opening of this presentation, the way that we calculate our benchmark prices, we believe is fundamentally different. Our view is that the calculation of benchmarks in the 21st century should not be a journalistic endeavor, but rather should offer the end user, in other words, the listeners on this call, clear and transparent calculation logic, because methodology should be, particularly for the liquid markets, a series of clear mathematical steps to go from input data to final benchmark price. And we believe that we have designed and codified exactly that. You can see in the middle of the screen an illustration of our methodology flowchart, which we designed for every single one of our indexes. And that is to give the end user, the client, a clear line of sight as to exactly how the general index system will produce a benchmark price under given market conditions. We are trying to move away from the black box approach. We're trying to move away from the surprise. We indeed don't want the end user to be surprised by how we arrived at a number on a given day. No reliance, in other words, on editorial judgment, as it were, but rather clean and clear mathematical rules. This approach, we believe, offers advantages, particularly during critical periods of volatility in the market. As everyone knows, twice a year, the gasoline market transitions from summer grade to winter grade and vice versa at the end of March and then again at the end of September. And during those periods of seasonal transition, particularly when you have thin liquidity during those 3 or 4 days, it's especially important that traders and brokers have a clear understanding of exactly how general index will calculate their prices, depending on the relative volumes of summer and winter grade on any given day. And all of that logic has been clearly delineated in our methodology documents. We also have been, over the course of this year, developing our idea of the universal swap. And this is germane to the physical market insofar as the valuation of the 430 swap is a key component in setting the price of a notional trade used for the final assessment in the absence of any trading liquidity on a given day. We try, and indeed we succeed, I would say, in speaking to all of the paper market participants who are active on the EBOB swap to get their view of the 430 front-month EBOB swap value. We then take what's known as the Olympic average, subtract the high and the low, and an average of the remaining submissions becomes our assessed price for the 430 swap value. And this value is then utilized in the construction of a low liquidity price assessment. And because we follow that clear and consistent approach, we believe that our 430 swap valuation, our universal swap as we call it, is more in line with market expectations and the views held by the paper brokers. Next slide, please, Andy. And so, having offered what we believe to be a market-leading benchmark on Eurobob, we're happy to say that over the last 3 years, we've had several successes in winning over the market towards our way of doing things. You know, we've been producing Eurobob prices since our launch back in 2020. We've shared our approach with all of the key market participants who have analyzed our data and validated our approach. They're comfortable with our methodology and the quality of the data that we offer. We're very happy to say that for some time now, general index Eurobob data has been deployed in the industry for functions such as P&L reporting, mark-to-market, inventory valuation. So even though we had yet to achieve full market adoption at that time, that hadn't stopped market participants from being able to utilize us or look at utilizing us for some of these functions. We're very happy to say that 4 key participants in the Northwest European gasoline market have already used General Index Eurobob for trading either blend stock or components, several of whom I believe are on this call today. And through our engagements, we have established that all of the key participants in this market are open to trading physical gasoline on a general index basis. That is their comfort with our methodology and our number. As Neil alluded to earlier, a full adoption of General Index Eurobob will help generate significant data cost savings for the industry. And the missing ingredient until now had been the paper side. In other words, instruments to allow market participants to be able to hedge their exposure to General Index Eurobob. And that brings us, of course, to our happy news for the day. So next slide, please, Andy. And our happy news is that ICE has announced that they are listing 3 new futures contracts as of Monday, 26 June, which will be settling against the general index price adjustment for Eurobob Non Oxy barges. These 3 contracts will be a standard futures contract reflecting a contract size, a lot size of 1,000 tons, a mini futures contract reflecting a lot size of 100 tons, and the balance of month equivalent of that latter contract. It is not lost upon us, or indeed the wider market, that this is the first time we can say in decades that the market has access to futures contracts on a major exchange, which are based on a settlement basis produced by a new benchmark provider. And so this is very exciting news indeed. There could be more general index derivatives being listed later in the year, driven, of course, by feedback from yourselves, those of you who are in the market. And we now have paper counterparts to the physical price reference that we've been socializing in the market for the last 3 years. Next slide, please, Andy. And so we've been working with traders and middle officers across the market to ensure that the relevant codes for these new instruments are mapped and available in their systems to allow traders to be able to trade these new contracts. For your information, we've put the relevant codes up on the screen to allow you to be able to map the contract to the right code. We've had questions about people wishing to be able to trade arbitrages or cracks using the general index instruments. And this can be done quite easily by constructing legs for the relevant portions. And so, for example, if you wanted to trade in East-West, you could use the existing SMT code, which is the Singapore 92 RON contract. And one of the new general index instruments can be the European leg of that East-West. And similarly, if you wish to trade a crack, you could construct a leg whereby one of the new instruments becomes the gasoline leg of the trade and Brent futures representing the crude. A question that has come up as well previously is what happens with the E5 and Oxy and those market participants who continue to have exposure to this legacy commodity. We are engaging with market makers and traders to ensure that there will be a price reference and a market that people can use to price out legacy contracts, so that doesn't hold up the broader market adoption and transition to this new grade. We're very happy to say that we've been having some quite intense discussions with several key brokers and traders who are active in this market. And therefore, we do believe that the first trades of these new contracts will be happening shortly after their launch next Monday. Next slide, please, Andy. We come now to the final portion of this presentation regarding our custodianship of the benchmark, namely, how does General Index intend on handling and maintaining the integrity of the benchmark once it achieves full adoption? And for that, I'm pleased to hand over to our head of compliance, Mr. Jonathan Hill.
So just looking at the list of registrations for the benchmark, and good morning, everyone. It's good to be here with you. I'm conscious that I don't know most of you. There's a couple of long-standing compliance professionals on there, but I just thought I'd introduce myself as head of compliance at General Index. Prior to this role, I have roughly 20 years experience, split more or less equally between first the financial regulator, the FCA's predecessor, and then the compliance teams of one of the oil majors, specializing on compliance and regulation issues virtually all of that time relating to energy derivatives trading. We wanted to put a compliance section into this webinar because whilst, as Neil and Saket have rightly made clear, we are excited to be reaching this stage of development and have this offering from the market, which we very much hope is going to be successful. We just wanted to emphasize really that it is a considered excitement, and that we very much intend to do this properly. We take it very seriously, and we believe we've got the expertise and the processes in place to make sure that we can fulfill that aspiration. So just as an overview of our compliance standing, if you like, we took an early decision strategically, we see it as a competitive advantage to walk into regulation. So to seek and achieve an FCA authorized status, which we've had for about 2 years now. Conscious very much that there'd been a lot of market feedback about lack of accountability in the sector. We've walked right into it and embraced it. And we see that as very much as a positive thing and hope that you do too. Because of that, and nonetheless anyway, we are compliant with the UK/EU benchmark regulation, and we have the required annual audit of our standing against IOSCO's oil price reporting agency principles, which you can find on our website and which we'll be updating shortly according to the annual review requirements. A couple of points we wanted to make. We set the same regulatory standards across the whole of our business. So everything we do, we treat as being regulated business. And we apply the same high standards to all of it. We don't cherry pick or be selective about where we apply the highest standards. We have set up an internal governance structure to ensure that we comply with these regulations on an ongoing basis. But it's not just about compliance with regulations. Obviously, it's about running benchmarks that you can trust, benchmarks that have integrity. And that's what the purpose of these groups listed out on the slide are. And all I would say about those is that, from the bottom down, the data review group meets sort of on a real-time basis. It's more or less a Teams chat between our pricing teams and their directors, with input from the senior members of the company where required to make real-time decisions about inclusion of data points or things which are changing in the markets or things which need addressing. Whereas at the top of the chain there, our compliance committee, that's a quarterly meeting with formal minutes being taken, and that very much focuses on our ongoing compliance with regulations. In between, with the benchmarks committee, we focus on issues which emerge from the day-to-day running, and also that's where we will consider whether any changes to methodology are required. So moving on, please, Andy. Our responsible stewardship of these benchmarks. So I mentioned our data review group that will be monitoring ongoing performance in a real-time basis. It's something that we have for all of the benchmarks. And where they observe something which looks like a change in market behavior or something which needs addressing, then if a decision is made, then that will be put into the GX code to ensure that there's future consistency. So we very much aim to be consistent in how we do this. However, we're particularly conscious that obviously now we have listed benchmarks and that people will be trading on them, that it's important that we have a focus group that really focuses on them and has the right expertise. So we will have this benchmark review group, which I will chair and be joined by our Chief Operating Officer, Phil Shaw, who I dare say many of you know, and Saket as our European Pricing Managing Director, together with Lucy Brown, who is our real market expert on gasoline. I'm sure many of you know Lucy. But we will listen to you. So when we're making decisions and considering what's been going on in the market, we very much want to hear feedback from the participants, and where we will listen to it. And as part of that benchmark review group, we will consult with the market infrastructure providers who are relevant in this space. We listed out there, Sake's provided a number of scenarios there on the slide, which are examples, not exclusive, but it could be things which the benchmark group might have to consider. So just to read the top one there, that say in a situation where a seller was continuing to offer despite not loading volumes at its own terminal, and that was causing market discourse, and someone had reached out to us on that, then that is something that the benchmark review group would need to consider. And there are some other examples there on the slide. I won't read them all out, but these slides will be available after the webinar. And I dare say that the scenarios Sake has pulled out there are familiar to most of you. However, we will look at things in the round, and just because there's a scenario there on the slide which might give an indication that an intervention from us is needed, we are conscious that these are physical markets and there are real things happening. There are logistic considerations, and that sometimes there are legitimate reasons for not being able to behave as one has said one would. And providing we understand them, then they will all be taken into account in how we proceed. Next slide, please, Andy. So this slide just sets out our intended procedure, if you like, our commitments to you in how we will run this benchmarks review group, and sort of by extension the benchmarks themselves. So where there is a set of circumstances which need consideration, we will contact the parties concerned and gather information, both by obviously talking to and listening, but also asking for relevant information and documentation. As you will expect, we will then move on to review those. And again, as I said, we will consult where we think appropriate with market infrastructure providers. And we will take account of all of the circumstances and aim to achieve a bilateral resolution between the counterparties and keep abreast of the discussions between them. After our review, it would depend what the determination of that review is, but we would then make a determination as to whether and for what duration. Clearly, we need some sanction where it's clear that people haven't honoured their commitments, and there seems not to have been a good reason for that. And we know that obviously people want to contribute to these benchmarks, and that the potential sanction of them not being able to do so for a period to be set according to the circumstances and the committee's determination, then yes, we may take the decision to not allow people to contribute to the benchmark for a given period of time as a consequence of the determination of the set of circumstances that have prevailed. Finally, within 2 business days of making that determination, we will make a determination as to whether there should be a formal consultation in relation to the methodology of the benchmark, because it may be that what we've observed is clearly signalling that actually some change of methodology should be considered and may need to be put into effect. And again, I would just emphasize our undertaking there that that is legitimate consultation, and we absolutely will want to hear your views and take account of them in the determinations we make. So I hope that gives you a good overview of our commitment and how we intend to proceed. But we look forward to operating it in a real-time basis. So thank you. Back to you, I believe, Sake.
Thanks very much. The key point to stress from the last couple of slides is that the market very often looks to the benchmark provider to take a firm hand to ensure that the integrity of the benchmark is preserved, to ensure that any complaints that are made are dealt with swiftly. In other words, just to make sure that things are running smoothly, and that any issues are dealt with front and center. And we intend very much on being that custodian of the benchmark. We intend very much on taking those responsibilities seriously. It is important that we take a consultative approach and bring the market along with us on any significant changes to the benchmark, but nonetheless, it is very much General Index's intention to be proactive rather than passive when it comes to the responsibilities of handling a physical benchmark. And that brings us now to our final slide, which is what comes next. So to slightly summarize a little bit of what's been covered previously, over the last 3 years, we have developed a set of gasoline benchmarks with a clear and consistent calculation logic that's been codified. We have removed editorial judgment and subjective criteria from these calculations. The market, yourselves, have validated our approach and accepted the robustness of our price benchmarks. On the commercial side, it's very clear that the savings on the table from a full adoption of general index Eurobob are quite significant. We are offering the industry a way, and the industry is taking us up on the offer to start breaking up the big data bundles and allowing for fair access to data at a reasonable cost. And the final point that I wish to make over here is when it comes to market adoption itself. There are several advantages to adoption on this market that may not be present on some other markets. The first is that there will be no change to the day-to-day physical barge trading mechanism on Eurobob. The physical brokers who are active in this market, with whom we are strongly engaged and have been for several years and who are fully bought into the concept, will continue broking their day-to-day barges and reporting these trades. So there will be no change on that side over there and no disruption to the trading mechanism. The second is that we are taking advantage of a natural bifurcation in the road. The transition to E10, this tipping point that is coming, is inevitable. The drip effect of the end user demand moving from E5 to E10 and the physical volumes moving from E5 to E10 means that a transition on the paper side cannot be avoided, and by all accounts is going to happen over the next 6 months or so. And consequently, given that market participants will have to start moving their E5 paper liquidity over to E10, will have to start hedging and trading E10 paper rather than E5 paper, there is the opportunity with these new instruments to be able to start doing so on a settlement basis using data from a new benchmark provider, in other words, general index, because we are offering not just a more robust physical price reference, but we're also offering significant data cost savings. And I'll leave you with the thought that there is precedent for change in the Northwest European gasoline benchmark. The settlement basis for the underlying derivatives in this market moved from one benchmark provider to another about 10 years ago. And then subsequently, because of the specification change from Eurograde to Eurobob, there was another change again about 13 years or so ago. And therefore, there is clear precedent for this, and therefore it can be done again. And we are seeing that change happen right now, and we want to bring everyone along with us on this change. And so now I will open the floor up to questions, and I thank you all once again for joining us.
Thank you very much, Neil, Saket, and Jonathan. We'll now open the floor to any questions you may have. We've had a couple come in while you guys have been speaking. If we run out of time to answer all of your questions, we'll certainly make a point to respond to you via email. Again, please use the Q&A function at the bottom of your screens to ask your questions. So a couple of questions that come in, and I think, Saket, I'll direct these towards you. Somebody's asking where the intermediate grade is.
Yes, thank you, Alex, for the question. So this is a question that has come up previously in the context of the gasoline benchmark, because obviously the only two seasonal grades that are currently accounted for in the calculation logic are summer grade and winter grade. But during the periods in between the use of full summer and winter, you do have the usage of intermediate grade in markets like in Germany. And so it is a perfectly reasonable question to ask, and perfectly reasonable that the end user demand during those 2 months of the year, particularly in the German market, is the intermediate grade, and therefore this is a matter for us to consider. The challenge historically in the past has been developing a methodology and a calculation logic that includes intermediate grade that is acceptable to all of the key market participants, because what we don't want to do is to split liquidity or to cause liquidity to fall. And therefore, while it is important for us to make sure that our benchmark is as reflective as possible of the gasoline market, it is equally important for us to bring everyone along with us. And therefore, it is something that we intend as the custodian of the benchmark to raise and to discuss and to consult with the market. And if there is a way that we can develop a logic that meets everyone's needs, we can certainly implement that. But we will have to do it in consultation with market participants.
Thank you, Seke. Another question is, all products are 4:30 UK time marked. Why not do the same with gasoline? Volume weighted average of a flat price is quite old school and not necessarily reflective of modern trading.
Another perfectly fair question. One idea that we had looked at in the past, given that you have trades taking place as differentials to swap, is to average all the differentials to swap and then apply that average diff to the 4:30 swap valuation. And so that could be one way of tweaking the methodology to be able to account for that. One complication that you may have is if people are trading physical and swap at various points during the day, then the price at which they transact those trades, given the volatility in the swap because of volatility in underlying crude, amongst other factors, might lead to some dislocations and variations. And so there is a way of doing that. Mathematically, from a methodological standpoint, it would not be difficult, but again, we would have to ensure, much like the answer to the previous question, that we have buy-in from all of the key market participants to be able to enact such a change.
Thank you, Seke. Another question, will paper trading be solely on the ICE trading platform?
Yes. So at the moment, the only instruments that are going live imminently are those that are listed on the ICE exchange. The trading themselves can take place through different venues, and from some of the interactions we've had with market participants, there are different ways that one can transact these besides using the ICE software. But these are ICE cleared instruments to start with, and there may be more derivatives and instruments down the road that we can announce in due course to be able to give the market an even wider choice of paper to be able to do their hedging and trading. But to start with, yes, these are just the 3 ICE cleared instruments.
Thank you. Another question, how does GX see the role of E5 oxy gasoline over the next 12 to 24 months?
This is a key and interesting question because, of course, as much as we talk about the growing role of E10 physical gasoline across Europe, there are still areas, and particularly I think in the German market, where E5 oxy gasoline remains the dominant grade and remains in use in big volumes. And therefore, it is perfectly reasonable and perfectly fair for market participants to be able to need or to be able to utilize a price reference to be able to price all of those trading and supply activities. And so we are working with people in the market to be able to offer a price reference so that people can price out those legacy positions. But our core starting point is that ultimately the market needs a liquid price reference against which to be able to enact all of their trading. After all, Eurobob derivatives contracts and the Eurobob physical price reference are used as an anchor point for people to be able to trade all manner of blend stocks and cargoes and components with differentials used to account for variations in quality and other factors. And so our hope is that by shepherding, by herding more market liquidity towards E10, we can help to build overall market liquidity while at the same time working to develop solutions that allow people to be able to price out any residual E5 exposure.
Fantastic. Thank you very much, Seke. Okay, so that brings an end to our question and answer session and indeed to the webinar. Thank you all very much for attending. We hope that you found it informative and useful. Once again, this webinar has been recorded and will be made available for you to replay. For any further information on General Index, then please email info@general-index.com and a member of our team will be in touch. Again, thank you very much for joining us today.